trading is for people who like losing money, and here's why. Day trading has gained a ton of popularity in recent years, especially during the pandemic when everybody was at home and attempting to figure out how to bring in extra income. Fueled by the promise of quick profits, it's become something like a phenomenon, with countless individuals jumping into the markets with dreams of striking it rich. But is it really as easy as it seems? Let's start by looking at the cold hard numbers. Statistically, day trading is known for its high failure rates. According to CNBC, most day traders lose money, but it's even worse than you may think. According to a study done by the University of California, only 13% of day traders were consistently profitable over a 6-month period. And according to a different study, only 1% of day traders were able to consistently make money over a period of 5 years or more. In fact, in 2020, the year that many people decided to become day traders, 72% of day traders experienced a financial loss, according to a report by the Financial Industry Regulatory Authority, known as FINRA. The truth is, most people don't have the brain power to be a successful day trader. There are way too many emotional and psychological challenges that day traders face. The intensity of the markets can take a toll on mental health, leading to stress, anxiety, and emotional decision making. And when you make a decision in the stock market based on emotion and not logic, the outcome usually doesn't turn out in your favor. It's crucial to recognize that successful day trading isn't just about being able to read a chart, it's about mastering your own emotions and reactions. Markets can be totally unpredictable and highly volatile. Even the most seasoned day traders can find themselves on shaky ground when faced with sudden and unexpected market movements. The ability to adapt and make split-second decisions is a skill that takes time to develop, and not everyone is cut out for that fast-paced nature of day trading. In addition to all of that, when you are day trading, you have to think of who is on the other side of the trade. You are not only up against people who have had several years of training, but you are also going up against bots and algorithms that are programmed to know when to buy and sell. These hedge funds and corporations have way more resources and access to information that everyday traders like you and I have. Day trading was not designed for retail investors. While day trading may not work for everyone, there are alternative strategies and long-term investment approaches that might be more suitable for most people. So what would I recommend for someone who is trying to bring in extra income from the stock market? Well, you can just do what I do, and that is become an option seller. When you sell options, you turn the probability of profit into your favor. Certain option selling strategies have over a 90% win rate. Selling options is similar to selling car insurance. You pay for car insurance every month just in case you crash your car, but 99% of the time you don't get into any accidents at all, and the insurance company just keeps your money. That is exactly how selling options works. You get paid an upfront premium for giving someone the right to buy or sell stocks from you at a fixed price within a specific time frame. If things go well, you keep the premium. If things go the other way, you could be obligated to sell or buy the stocks at the agreed upon price. There are several different option selling strategies such as selling puts, covered calls, credit spreads, iron condors, strangles, straddles, and a few more. Out of this list, let's take a look at selling puts. This is how selling puts works. Imagine you love a specific car, but you're waiting for its price to drop a bit before buying. So you make a deal with the dealership. You say, I'll commit to buying this car if its price goes below a certain amount in the next month. In return for making this commitment, the dealership pays you a fee up front, like a deposit. Now, if the car's price stays above the agreed upon amount, you keep the fee and don't buy the car. It's a win because you earn some money without purchasing. However, if the price drops below your agreed level, you end up buying the car at the lower price. Selling a put is essentially making a deal to potentially buy something you like at a lower price and getting paid for the commitment up front. Now, let's take a look at a real example. So here we are in the Thinkorswim platform, and let's say I wanted to sell a put on Tesla. Well, I would just come over to the options chain and type in Tesla's ticker symbol, which is TSLA, which I have already done so. Now, the next thing I need to decide is what expiration date would I like? Well, I want to go sometime within the next 30 days. So I'll come down to here, February 23rd, that is 29 days from now. And now I need to select a strike price. This is simply the price I would agree to buy Tesla shares at. So I would come over here to this column that's called delta. And if you look down here, the delta is simply the probability that the event occurs. So if we look at this $150 strike price, it says 0.88. So it's saying there is an 8.8% chance that the stock price drops to that strike price by this date. Okay, so it's saying there's an 8.8% chance that Tesla's stock price drops down to 150 by February 23rd. And I like those odds, so I'm going to go ahead and sell a put at 150. Now, if we look at the bid and ask, you can see the bid is $1.19 and the ask is $1.22. So we will get somewhere between that price when we sell the put. Now remember, every options contract is worth 100 shares. So we will receive 100 times that amount. So we would collect somewhere between $119 and $122. So we'll come over here and we'll click it, and I want to sell a put. And down here we select how many contracts that we would like. For this example, we'll just select one, and I'll select the mid price, which is 1.19. So if we confirm, you can see right here that in total we would collect $118.59 for selling this put. So just as a quick recap, if Tesla's stock price stays above 150 by our expiration date, we just keep the money and go about our lives. However, if the stock price drops below 150, then I am forced to buy 100 shares of Tesla at that strike price. But as we've seen from the Delta, there's only an 8% chance that the stock price drops below that strike price by that date. So the chances are we just keep our money. If you'd like to see how I bring in full-time income every year from trading stock options, you can join my community and online course called Trade to Freedom. Here you will have access to an A to Z options course, and within the community you will be able to see my exact trades in real time, along with having access to me. If you're ready for that type of transformation, the link is in the description below. At the end of the day, it's important to acknowledge that there are successful day traders out there. However, it's equally important to distinguish success stories from the broader reality. What works for one person might not work for the other. But seeing that in a 5-year span, only 1 out of every 100 day traders will be profitable should let you know all you need to know. I would love to hear your thoughts and experiences in the comments below. Share your journey and insights, and let's build a community that learns and grows together. If you found this video at all helpful, don't forget to give it a thumbs up and share it with anyone who might benefit. Thank you for watching, and I'll see you at the next video. Peace.